From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello. Welcome to the COB. I'm Nadine Blaney. It's great to have you here with us on RBA Day. Also, potentially, we'll be calling it Rebound Day, maybe across the globe. Let's see. It certainly happened in the Asian markets and including our own market, which did close higher by about half, well, close to 0.6%. There's the CIBO Australia Index, but I can tell you that the local S&P ASX 200 has moved lockstep with that pretty much throughout the day. We did see a little bit of an uptick, I suppose, in the last half hour or so, but no immediate reaction to the RBA, leaving interest rates on hold at 4.35%, as widely expected, although, you know, in many people's view, it was a bit of a hawkish hold. So, of course, sticking with the rhetoric that it is all about inflation. Although, if you go to our website, ausbiz.com.au, we did have a great panel discussion around about when that decision was handed down. And what I sort of really took away from that conversation is that employment is the next frontier. So whilst the RBA doesn't necessarily want to be at the helm, letting inflation get away with us, they also don't want to be at the helm if we start to see some real sort of negative signals coming from the unemployment market and let that get away with them. So hawkish hold, employment, the next big data point. We'll be talking about that with my guest who's coming in just a moment, Martin Crabb from Shaw Partner. He's the CIO there. But a story in and of itself is the fact that we have seen Asian markets rebounding for the most part. I will say the Hang Seng is still into negative territory, but the Nikkei up by 8.6%. And also looking at the Chinese mainland market, at least the composite in Shenzhen is up by about 0.25%. So still yet a little bit of weakness there, but the Kospi, after having all of that real sort of fear in the market yesterday, coming back to the tune of about 4%. Week to date here locally, we're still down by 3.3%. So safe to say, volatility is not over. We do have still results in the United States to come through. We've got FOMC speakers. We've got geopolitics, and we've got, that impacting oil along with the possibility of demand destruction. So there's plenty of talk about. Quick run through some of the sectors of the day to see where we saw some of those big falls. Look no further than Woodside Petroleum. So a bit of news coming from Woodside, a bit of an ammonia project that it's bought. Market's not looking on that too favorably from what I can see. Some market talk today coming through that it could exert dividend pressure. Shareholders don't like that. Santos, though, up by about 2%. Cooper Energy in the small end, 2.25%. Tech, well, this was a bloodbath yesterday. And look, picking itself up off the mat today, but you can't say that, we've recouped anywhere near the losses that we saw yesterday. But again, the question always becomes, where are the opportunities? I was a host on the call today. My guests, Sean Hickman from Market Matters and Mark Moreland from Team Invest, they were sort of naming the price that they'd be willing to pick some of these beaten down companies up. If you'd like to have a listen, it is up online. NextDC, it's seeing more bookings coming through, expecting revenue recognition from this contract utilization that it did announce today to start in FY27. The big banks, ANZ is the outlier there, off by 1.2%. Don't forget, we're gearing up to get full year results from Commonwealth Bank. By memory, it's the 17th. I will ask my guest about that one. And some of the top corporate stories today. I mentioned that Woodside Energy buying that gas-based ammonia project on the U.S. Gulf Coast. So I think there's a lot going on with Woodside right now, if you consider that it's also got that bid out for the acquisition of Tellier something, and it's for the Driftwood project in the U.S. Gulf as well. Coronado was out with results today. Revenue slump of about 10% to $1.34 billion. Lower coal prices, but also some weather delays. And Audinate, it wasn't the result, it's foreshadowing the result, providing a soft FY24 outlook, which does imply a large consensus downgrade. Worst performer actually today. Speaking of data centers, Macquarie bought a data center in South Korea for about $537 million. So that AI thematic does continue. And Westpac has decided to stop offering new home loans through its RAMS subsidiary as part of a plan to simplify its business. So that's just putting those stories on your radar. Westpac shares up by about 0.75%. Macquarie Group was down more than 5% yesterday, but today a bit of green on the screen, up 1.7%. All right, let's get to it. Martin Crabb from Shaw Partners. Hello.
Good to see you.
Good to see you as well. RBA on hold. We were just listening to Michelle Bullock there. Interesting to say that she's saying for all those commentators who were certain there would be a need for a cut or certain that there would be a need for a hike, she's saying, great that you've got all that certainty, but it's complex out there.
Yeah, she's jawboning the market, isn't she? So the market's got ahead of itself in terms of looking for cuts this year, and the only two options on the table were a hike or a hold. And the statement of monetary policy, which I had to read through before I came down, Nadine, suggests that the economy is stronger than they thought it would be. Inflation's going to take longer to come down. They don't think the government's going to repeat the relief for energy bills. So headline inflation is going to go back to 3.7 in December 2025. So it's going to be a long time based on their numbers till we get into their target band. So we're looking at rates on hold, but we get a couple of bad CPI numbers or a bad wage outcome or something, they can hike. They can still hike. So we'll interesting to see how the futures curve shifts on that. We've gone from having the Fed now needs to cut like 1 million times before Christmas, and the RBA is on hold. But financial conditions are tight in Australia. They're restrictive. Monetary policy is restrictive. Mortgage rates haven't really come down that much. Business lending rates haven't come down that much. People are still paying 12, 13, 14% of their income on their mortgage. Things are really tight. And yet the Reserve Bank's saying maybe they're not tight enough. So you kind of think that this might be at risk of keeping things too high for too long, and the labour market will start to show up, which is exactly what's happening in the States.
Mm-hmm. Yeah, well, let's talk about that then. Do you think that there was an overreaction? And I suppose that it's so multifaceted. I mean, there's many things that investors, could be worried about.
Yeah.
But it was sort of the jobs data, being the JOLTS, being the non-farms last week. Well, you could say the ISM manufacturing as well.
Yeah.
But, do you think that this has been an overreaction?
Yeah, look, potentially. But the fear is this, that the labour market softens and then it cracks. Like, that's the history, is that when you think about it, if your business lays off 1 or 2 people, no biggie, but they're my customers, so I need to lay off 1 or 2, and then you lay off 1 or 2, and then it becomes 3 or 4 or 5 or 6. So there's this idea that you get this acceleration, and this is what the SARM rule is designed to measure, is that you go and look at what point do you think the labour market's not softening anymore, it's really starting to crack, and that's when that's telling you that monetary policy is too tight, but the train's already left the station, we're going to have a recession. And that's exactly what that payroll number on Friday in the US was telling us. Now, is it 1 month? Was it impacted by weather? Maybe 450,000 people couldn't work because of weather. So there's all this other stuff in there, but there's just enough in there, and there's enough history. It's a bit like the inverted yield curve. There's enough history to say when that unemployment rate moves like that, that's telling you it's too late. So even if you start cutting now, we're still going to head into a recession.
Yeah. Everybody on Monday morning was Googling the Shaw rule?
The SARM rule.
Yeah. I got to say,
well,
I might have.
I think you weren't alone. But that's the futures market there for the Fed funds. So we're looking at quite a dramatic shift. We've got a week ago and a month ago just to show you how much the futures market's moved. And at some point we were looking at 50 points in September and 75 in November, which is like probably a little bit overdone.
Yeah, you got to. I mean, we've been here before where you've seen the market really react fiercely, calling for successive interest rate cuts.
Yeah.
Do you genuinely think that 50 basis points is too much to ask from the Fed? Goolsbee was out last night talking again, saying that financial markets not the Fed's mandate. It is price stability, but it's also it's also jobs.
Yeah. Well, he was saying, look, we need to shift from being just inflation fighting to thinking about unemployment. The opposite measure from Michelle Bullock. She's saying we don't have to worry about unemployment. It's all about fighting inflation. So at some point they shift through this dual mandate. They become less focused on one part of it and more focused on the other. So Austin Goolsbee certainly last night was saying we need to think about the economy now, not just about inflation. We think we're done. the luxury they have, for want of a better term, is the 6 weeks till the next meeting, and they'll get another bunch of employment data. So if it was a one-off, they don't need to flinch. I think they would prefer to do 25 because it just shows they're in control, and it won't scare the horses either, right?
Yeah, because emergency or volatility begets volatility, but if you act like there's an emergency, well,
yeah, if they do 50, people will think there's something wrong,
yeah.
And that'll send a very nervous message to the market. That's not what they're trying to do, because what they also pointed out is that the stability in financial markets is also part of their mandate. It's not just unemployment and inflation. They need to make sure that the financial markets are working and stable. And to have one of the largest stock markets in the world move 12% in one session and 10% in the other, that doesn't feel like stable markets to me. I mean, that's not their remit. But the volatility in market, I mean, the VIX went to over 62 last night, Nadine, which is like, that's not a stable market.
Yeah,
you know
yeah.
what I mean?
And that's what I was going to say, is that
Yeah.
even though we have seen sort of July, August sell-offs before, that
Yeah.
whipsaw that we were seeing. I mean, this time yesterday, when I was, shutting down the COB, it was, triggers being flagged in South Korea.
Yeah.
Taiwan's market was falling out of bed.
Yeah, circuit
Volatility
breakers
index,
were being
circuit
impacted.
breakers,
Yeah,
Nikkei futures. I mean, it's been pretty wild. So,
Yeah.
so what are you telling us here, that we need to keep calm and carry on?
Yeah, there's a little bit of that keep calm and carry on, in that we do get at this time of year, July, August, we do get these sell-offs. They're not uncommon. This is just over the last sort of 10 or 15 years, we have seen some pretty significant sell-offs in this time of year, last for a couple of months, and then the markets recover, with one notable exception being the GFC, which just kept going and going and going. But volatility around this time of year. Now, there's all these arguments about people being on holidays and market activity being thin, and also it's reporting season. Reporting season is a little bit volatile. So if you get a softer reporting season and very thin volumes, you get a bit more volatility. We know that most of Europe's on summer holidays. We know a lot of traders were not at their desks on Monday, which is why the Nikkei and other Asian markets got hit so hard, because they were trying to find liquidity. So it's not unusual to have these kind of movements this time of year.
Okay, so putting that all into context, you mentioned that we still do have earnings going on in the United States. So leading up to this, market meltdown, most of the results were coming in pretty well. There wasn't a lot of fear being expressed in the commentary coming from CEOs. Now, everybody will be very attuned now to anything that's talking about jobs, unemployment, any layoffs, and the consumer. Yeah,
and look, there's a number of examples of companies that have come in with guidance and outlooks that's less than the market. Even Audinate in the Aussie market, that's a global technology company. Their guidance was 50% below consensus. It was a big thing. We've seen Intel sell off very dramatically. So there's, it hasn't all been roses and chocolates in this reporting season. I think there's still vulnerability around. We've got things like Novo Nordisk, I think, reporting tonight or tomorrow night. So if they guide lower on GLP-1 drugs, for example, that's a very elevated stock. So there's still, I think, a lot of earnings risk just going through this result, just based on where valuations are. So you don't get these sell-offs in a cheap market. You get these sell-offs when PEs are elevated. So I still think there's risk. I think there's going to be continued volatility in markets. I mean, to have 10-15% moves in major markets tells you that the market's very finely balanced. There's lots of hot money around. We've seen big moves in things like crypto. So there's lots of risk on, risk off going. So I think people just need to sleep with one eye open for the next couple of weeks, Nadine, and just be cautious.
Any big opportunities that you're seeing yet in our market? Not
yet, I think. But valuations have become a little bit more attractive. Obviously, the market's off 5% in Australia so far this month. But I still think there's probably a little bit more downside in some of the names. We're seeing things like Domino's, IDP Education, some of these quality growth stocks that are having a bit of a downgrade cycle. They're looking really interesting to us at the moment. I still think the gold sector looks fantastic, notwithstanding costs are going up and capex is going up. The outlook for gold with falling rates looks really good. So I think there are some stock picking opportunities out there, but the market as a whole, it's probably not screaming value at it quite yet.
Got it. Martin Crabb, Shaw and Partners, always good to have you in.
Thanks for having me.
As always, but especially on an RBA day. How about that? All right, let's get to, well, I think it's our stock of the day. It was Treasury Wine Estates. Sean Hickman, Market Matters, Mark Moreland, Team Invest. Let's take a listen.
like the way they've evolved their business. Obviously, after it had its legs cut off when China closed the doors, they've evolved very well into the US. And I think as a business, they've done a good job of that. I think the market got ahead of itself about how well China was going to let wind back in, and they built on 2 excessive earnings. But I think going forward, we're long, we like the stock, and we think it's going to outperform.
Look, if you look at the numbers, its return on capital is only 5.6. We have a minimum of 10%, so it doesn't hit it. It doesn't pass our screening, so we would never look at it. If I look at it from a return point of view, it's still currently on a PE of 25.8. Its EPS growth rate average for the last 6 years has been negative 4.9, and sales have declined at 1% over that period. So it's pretty ordinary. Now, what Sean was saying is, well, they're positioning now to go better. Well, they may well, but from a price point of view, 25 PE is way too high for a company that's really in a turnaround situation, in our view.
So there you go. There's the verdict on TWE. You can listen to that in its entirety up on our website, ausbiz.com.au. Let's get across some of these market leaders. So this time yesterday, there were only two companies in positive territory, if you do recall. Well, what a turnaround today. And one of those companies that was the biggest losers yesterday was Deep Yellow. So we saw some bargain hunters, I dare say, move into the likes of Lovisa, Webjet up by 3%, Reliance Worldwide 3%, Paladin Energy close to 4% higher, and then Deep Yellow up by 4.76%. On the flip side of the page, some of those laggards, well, you heard Martin Crabb, CIO at Shaw Partners, talking about this, saying that Audinate has warned on FY25's outlook, although it does expect to return to growth in FY26, with this FY25 profit to fall marginally on FY24 and revenue to fall as well on FY24. The market's really downgraded it at like big ton, 37%, pretty close to it. Another growth stock, Pro Medicus, down by 6.7%. Although if you listen to today's episode of The Call, you might find something out about where Mark Moreland would be happy to buy Pro Medicus if we continue to see some of these real down days. Emerald Resources is also off, saying that it will continue future developments with Maca. And Red 5 put out an investor presentation. It's at the Diggers and Dealers Conference in Kalgoorlie, which has been overshadowed by all of the news of the past few days. But yeah, Red 5, they're one of the worst performers, off by 5.5%, and Woodside Energy off by 4.4%. Very quick run through the small caps. Appen, after falling 14% yesterday, up by 20% today. Flipping the page to see what was lagging, and Atlantic Lithium. These are all sort of resources companies here. Atlantic Lithium down by 15.3%. So last night we were very mindful of that ISM Services read. It did come in higher than expected, so that did calm some of the fears about the US recession. Tonight we get Eurozone growth in retail sales, expected to pull back modestly in June, although Westpac says increasingly outcomes are mixed by country. In the United States, we do get the trade balance. That's for June. The trade deficit is anticipated to narrow, reflecting broader underlying weakness in the consumption of goods. And speaking of consumption, we do get some big earnings out in the US, Airbnb, Uber, Wynn Resorts amongst them. But the one we'll have local flow through here is Caterpillar. Of course, Seven Group is the local distributor of Caterpillar, so we'll be keeping our eye on that closely. Tomorrow here, the New Zealand unemployment rate. We'll hear from RBA Assistant Governor Hunter, and a few earnings coming through, Light & Wonder and Arcadium Lithium. So we will still, of course, be digesting what's come from Michelle Bullock's media conference that has just wrapped up. Sounds like she's concerned about both sides of the equation going to hold for too long, or, letting that inflation genie get out of the bottle once again, or I guess to a more significant degree. So the local market making up some of yesterday's losses, some, I say, not all. The equity index overall still down about 3.3% for the week, but nice to see a little bit of a rebound happening here locally. Although I will say, and still stick with me, Martin Crabb from Shaw & Partner, my guest host here, saying sleep with one eye open. 7,680 for the S&P ASX 200. We look forward to seeing what's coming tonight. We'll get you across it all in the morning.